Pivot point, definition, formula, how to calculate, strategy. Technical indicators in trading are indicators that use mathematical equations and statistics to help traders predict asset price movements. Not infrequently the mathematical equations used here are equations that are difficult to understand and execute manually, especially by novice traders. However, there are also technical indicators that are easy to understand and execute manually. Pivot point is a technical indicator used to calculate the balance value of an asset in a trading period. Usually the components used to calculate pivot points are closing prices, highs and lows. This indicator is generally used by day traders to estimate the resistance and support levels of an asset the next day, predict the direction of the trend and determine when to enter and when to exit the market. If the price curve continues to move above the pivot point, it can be concluded that the asset market is bullish. On the other hand, if the price continues to move below this value, it means that the market is bearish. So that the analysis you do is more complete, you should also calculate the potential resistance and support levels first. After the forex market closes, immediately find the highest price points and the lowest price points on the trading day. Then, find out what the closing price was on the previous trading day. So, to find the results of this indicator, you have to look for the highs and lows on Tuesday and find the closing prices on Monday. Add those highs, lows and closes and divide by 3. Draw a line and mark P on the chart at this price level to mark. To understand what pivot trading is, let's look at the following image. In the picture above, the pivot point, P, is depicted in yellow while potential support is red and potential resistance is green. At the beginning of the curve it is seen that the price movement continues to move below the yellow line. After rebounding, finally the asset price movement continues to move above the yellow line, so it can be concluded that the market is bullish. H1/H2/H3 equals the first, second and third highs. L1/L2/L3 equals first, second and third lowest price points. According to YouTuber and trader Daryl Yahya, pivot points can not only be obtained from mathematical calculations as above but can also be found from observing candlesticks. As stated above, if the price moves above the pivot point, it means the market is bullish and vice versa. If the market is bullish, then you should open a long position, while if the market is bearish then short selling is a suitable strategy. Do not let you open a short position when the price only drops briefly and then rises again. Pivot points and Fibonacci retracements are two technical indicators that can be used to determine resistance and support lines. The difference is that if the pivot point refers to the price in the form of whole numbers, then the Fibonacci retracement refers to the percentage of the whole number, which percentage is the Fibonacci golden ratio. It is different if the resistance value is calculated by Fibonacci retracement. The difference between Fibonacci and other pivot points is that the first technical indicator will appear with several lines at once in a curve. Each line represents the Fibonacci golden ratio used, while the second indicator only appears with 5 lines, namely P, R1, R2, S1 and S2. This causes the Fibonacci retracement interpretation to be more objective than the pivot point. Therefore, make sure you choose which indicator to use carefully.